Well, good evening, ladies and gentlemen, and thank you for being with me this evening. It's good morning to our friends on the east coast of Australia, particularly those who are lucky enough to live in the grand state of Queensland. Thank you, Terry. And for the rest of Australia, good afternoon. Also, greetings and good afternoon to our friends across the ditch in the land of the long white cloud, who are having some interesting times at the moment. Their Prime Minister has resigned. They've got a new one. Things are changing rapidly. Wonderful, wonderful country, New Zealand. Okay, so let's move on because there is a whole lot to talk about and see if we can get all this stuff to work. Here we are. So markets are rational, orderly, and sometimes predictable. As you know, if you're a Danielcode trader. Nice to see all our friends with us. Vicky, welcome to you. Trevor, great honour to have you. Terry does all these wonderful banners for us. He's a closet graphic artist and very, very good at it. Phil's with us. Alparto's with us. Good to have you with us, Partho. Norbert up in that cold country in Canada. Nathan's with us over in New Zealand. You got the day right now, Nathan. Monty's with us, of course. He's a tutorial guy. Milton's with us, and Mark, of course, Mark L., a real stalwart here. Justin's with us. Justin, we better get a session next week, mate. I'll get you a invitation sent out today. Joe's with us. Jeff's, of course, with us. Greg Y. Greg over in either Colorado Springs or Texas. Not sure where it is, but grand to have you with us. Greg's a very, very good trader, tutorial guy, and he's also a wealth fund manager. Let's see, we've got all our usuals here. Get back where I was. Peter's with us, lots of those. Thank you very much. Miles, good to have you with us, Miles. It's been a while, so plenty more coming in now. Lots coming in now. Just a little bit of a late start. Joel from Vero Beach, good to have you with us, of course. Alan Al, he's a tutorial guy. Good to have you with us, folks. And let's see what marvels I can show you today. Here we are. So this is actually a slide from our last session, which was called Becoming Great, but it has so much to say that I thought I'd use it again. My mission for all of you is for you to become seriously great traders. And if you've been with the Danielcode for a while, I guess you're either there or getting there. As I said, some people already have become great, others are in the process of becoming great. But the Danielcode gives you a unique and entirely different insight and view to markets. So it follows that at critical points, the Danielcode signals will differ from all others, and that's a huge bonus. So today, we're going to talk about time again, and we're particularly going to talk about Gann, W.D. Gann, a famous trader, author, published a massive amount of writing, number of books, all of his courses, the egg course, this course, that course, any course you can think of, absolute prolific worker, Gann was. And he's a character that he's no longer with us, of course. He passed on in 1955, but he's a character who gets the extremes of opinions. I have clients who absolutely adore everything about Gann. I have other clients who just don't get it. I'm sort of in between because I reckon I'm the world expert on Gann. I really do. I spent 12 years, 100 hours a day on nothing but Gann. I had such a collection of his charts and his various courses. I needed a separate garage to store them. As well as that, I had a lady in San Francisco and another one in London buying me so-called Gann original charts and Gann letters and what have you. But for those of you who are really interested in Gann, and it doesn't matter if you come down on the other side of the argument. As I say, I dedicated a large part of my life to Gann, but I don't trade Gann now. I have nothing to do with Gann, other than I've used one of his expressions. The expression I use, time and price squared, comes from Gann, although he meant something entirely different to what I mean. But if you look at his Wikipedia page, that sort of lays out the arguments for and against. So I'm not going to say any more about it other than that I was a disciple and I am no longer, and you can work it out from there. Time was critical to everything that Gann did because the bulk of his work was around angles. He had angles which he called his 1 by 3, 1 by 4, 8 by 1, various angles progressing. He used, before the days of computers, of course, he used manual charts, and they were on squared paper. So 1 by 3 was 3 bars up and 1 bar across, where he was combining time and price. And price was, of course, at least 50% of all of Gann's work, which is why it's important, even though I don't think Gann ever actually understood time. But we'll leave that for another argument. I don't want to upset anyone. I know that I have clients who absolutely adore Gann. Let's start with my proposition for you today is that Gann used to say occasionally, if you are worthy, I will tell you the number. And the number he would tell you was 7, which is wrong. And I have argued for some time, and specifically today, that the vibration for all markets is actually 6. It's 6.21. It's the mathematical expression. But as we lose 31% of the bars on our charts due to weekends and holidays, the concentration on anything after the decimal point is totally irrelevant. That's the sequencing of it. We have got from the basic Danielcode numbers, we do some basic schoolboy math, and we get 29.6 days, which we say is a measure of time. And it happens to be very close to the length of a synodic month, which you can look up on Wiki, which is 29.5 days. Again, the 0.1 variance is not material. And that makes time 59. Bear in mind these numbers, because we're going to come to them a bit later on when we're looking at time cycles on the S&P. From those numbers, we get 2 more numbers, 45 days or degrees, and 365.37 days, which is very, very close to a calendar year. And we get the direction of how time progresses. It is for time, times, and a half. And you'll see how that works as we go on. So when you look at charts, remember that we're always splitting days. We're taking 365.37 days of data, of happening, of events, and we're spreading that over 251 trading days on our chart, because for futures and Forex charts at least, we don't have bars for weekends or public holidays. If you want to be more precise, you can take the Bitcoin cash chart, which trades on holidays and weekends, and you can use it for some very accurate timing. That's about, in my opinion, it's about all it's useful for, but nevertheless. But what's amazing is, despite the fact that 31, or almost a third of all bars are not on our chart because they're not trading days, the cycles manage to adjust to cover that, what should be an almost 33% error. and it's extraordinary. It's one of the, what I call the magic of markets, that happens. So remember, when we're talking as we go through, the time and price are the same thing on different axes. If you have any doubts about that, you can see these members charts that I've been creating for you since late 2007, and there's now over 40,000 of them, and they're all in chart archives. We protect them for clients for I think 4 or 5 weeks, and then they're posted in chart archives, which is a public document. And you can go through there and look at all those charts, and you will be pushed, I say is the word, to find a market that's turned anywhere except after target recognition of its Danielcode numbers. And you can see this chart here, which is quite an old one, but it shows you precisely how markets have this target recognition, how they find the Danielcode numbers, either on the bar high-low or on the close. Both are valid. And as I say, we've got a stack of charts to prove all of that. So, yes, we're obsessed with market turns, and there's a reason for that. All trends start and end with a market turn. For those of you who've been following these tutorials, and I talked a bit about this at our last webinar, I should say, markets are talking to you every day. They're literally telling you what they are doing and what time cycle they are following. And before the Danielcode, we didn't have the language to understand them. Now we do. And it's quite revealing, and it's going on all the time. It's exciting, and the most effective filter for your price trades is Danielcode target recognition. Absolutely vital, as you'll see. So remember, all markets are ruled by the Danielcode, and Forex and futures markets trade exactly the same on the Danielcode. Forex folks go to a lot of trouble to try and show they're different. They use expression like pips instead of ticks. But I started off as a Forex trader. Now I'm much more interested in futures. I just find the product more interesting. But they trade exactly the same way. And I know Forex guys like to pretend there's something different about them. There's not. All markets, in fact, trade exactly the same way on the Danielcode. So today we're going to talk mainly about the 6-day cycles, and 6 being the vibration of all markets. That's my proposition to you. And the difficulty for a whole lot of Gann students who are interested in time is they're trying to use 7, and it just doesn't work. So have a look at this chart. This is not real-time, real-life trading. This is just a representation of the 6-day Danielcode time signals on this particular chart, which is British pound Swiss franc pair. And you can see it's pretty staggering. There are 10 wins in there, about 23,000, 6 losses of about 1,300. And that's consistent with what we've seen before with these sorts of markets where there's some real volatility in them. It's true, the market giveth and the market taketh away. When there's volatility, markets are bountiful, markets are rewarding you, and that's what they're there for. When markets are consolidating or somnolent, get away from them. That's why I suggest to you that you should be trading more than one market, preferably 2 or 3. Make sure they're not correlated, or you'll simply be doubling up on whatever you're doing. So to get an estimate of this, what's a real version of this, there's no slippage in this chart at all. It assumes we got filled exactly where we wanted to. In fact, it's better than that, because I haven't even allowed for the 2-tick buffer for each trade on entry and exit. So you can take a fair whack away from those winning trades. But even if you take away 10 or 20%, you can see that trading Danielcode time cycles off the 6 cycle is absolutely magnificent. And we're seeing that all the day. And you tutorial guys who've been trading the half cycle, you will progress to the 6 cycle, and I'm more than happy to talk to you about it at any time. Our next chart is the Euro-Japanese yen, and I've used this chart on purpose, and I've called it the crazy. Those of you who follow either Forex or worldwide economic affairs will know that the Bank of Japan, the central bank, has been playing a game with markets, very successfully, I must say, for years and years and years, using essentially a form of MMT, or modern monetary theory. And basically what they've been able to do, and the whole aim of their fiscal structure, is they've been able to keep interest rates massively, massively suppressed, while also keeping a reasonable level of control over their currency. Now, economists rush to tell you that can't happen. But the reality is it has been happening for years and years, and it still is. And what you're seeing here, and I picked this chart because this is when the crazies get into it. Very recently, the chairman, Kuroda, of the Bank of Japan, decided that he would increase interest rates by 1/4%, do you mind? And it sent the futures, it sent the Forex market absolutely hysterical, with massive, great big ranges. So you can see here, this is, I picked this market particularly because it's difficult. And I picked it to show you that we've had that great big two legs up on the left-hand side of the chart. And since then, it's been in a downtrend. But what I'm showing you here is buy signals in a downtrend, which is a tough way to go. But it proves the point that these are Danielcode buy signals, time buy signals. And I want to show you something really simple and old. It's been forgotten, and it shouldn't be. It's a wonderful tool. And this is, the red line on here is a speed line. And basically it runs from a swing low up to the closing high. If you're working the other way, it will run from a swing high to the closing low of any leg. And one of the great beauties about markets, when you understand how the Danielcode analyzes them and it's revealed to you what's actually happening in them, is the total symmetry. The way these patterns just repeat and repeat and repeat, and the symmetry of markets is absolutely staggering. So if you take that speed line there, that shows you a very, very big, strong push-up. And the angle on that's probably better than 45 degrees. Back in the old days when I used to plot this all manually on graph paper, I could tell you exactly what the degree was, but we have computers now, and you can make that a bit sharper or shorter by just adjusting the size of the bars. But you can see it's a pretty aggressive line on there. So start with your first speed line and then duplicate it. All charting software has a duplicate function. So just duplicate it, and then just take that duplicated line and put it on every low thereafter. So you can now see this is about 7 months of chart in here. And you can see that in the whole time period, right through until just the last few days, really, this is a daily chart. So this is nothing like 7 months. Might be. This is October, November, December, yeah, January, February, yeah, well, 5 months anyway. Have a look at these parallel speed lines. They're pretty well all just about perfect if you're trading them and if you're using them as a stop loss. And there are a couple of ways of doing that. You can either say, when I get a close outside it, I'm going to tighten up my stops. Or you can simply use the line itself as a stop, but you need to be prepared to re-enter with the trend. And if you've done a tutorial, you know how to do that. But something as simple as that, simple speed lines, how can they be parallel over such a period? I mean, markets are supposed to be random, according to random walk theory. Here you are, you had a big run up, now you've had an extended period of this market correcting, and they're still running pretty much at the same angle. That's the sort of thing it just amazes me. I love seeing that and thinking about it. and I can think about markets for a very long time. So this was the dollar value of each of those rallies. Now, that's not to say you got that on your trade because you had to enter, and you don't enter right at the low, as you know. But just have a look at that. This is just a lot of money in all of those. And again, it's amazing how symmetrical they are. $1,500, $2,000, $2,700, $2,200, $2,200, a little failure, and 25. Just symmetry. That's what you get. This is the same thing, and this time I put the speed lines for you on a sugar chart. And I'm not going to dwell on it. You can work it all out for yourself, but pretty amazing, isn't it? From the swing low to the closing high of the move. Don't have to be too particular about it. You'll find it's very, very good. If you've got sharp eyes, you'll notice here that about the middle of the chart, the angle changes slightly, and it gets to be a little bit slower. So you don't have to be hidebound, but what you can just be doing is putting on a speed line, very old-fashioned way of trading, been practically forgotten now, but it works wonderfully as a stop loss. Either you use the line as a stop loss, or you can be a bit more sophisticated and say, I'm going to exit if I get a close below that line. I do that often. I find it's a really good and simple way to trade, particularly if you're trading a lot of markets. It simplifies everything. There's that symmetry of markets again. Why are all these lines parallel? If markets are random, they shouldn't be parallel, but they are. So, anytime you know something that others don't know, you have an immediate and huge advantage. And the biggest advantage of all is understanding time. And this is a gold chart. So we're going to talk a lot about gold today. Everybody who comes to me says, I want to trade the S&P and gold. Well, they're not always the best markets to trade. And by the time you've done a tutorial, I hope I will have shown you how to select the best trading markets from time to time. But this is a big chart of gold. This chart of gold starts way back in February 2020. And I've just jammed it in as much as I can, and then simply to keep it legible. Have a look at these time turns. Every single high of any consequence and every single low of any consequence is coming at the expiration of a 49-day cycle. And 49.6, you'll remember, is the first number in the Danielcode ratios. And it's a measure of time. It's 29.6 days is what we call time. There are other measurements, but that's the prime number for Danielcode measurements, 29.6. So all we've done is we put the 29.6 cycle on top of this chart and said, show me where it's going to create buy and sell signals. Have a look. It's extraordinary, isn't it? I have clients who learn this stuff in tutorials, and I've got a number of very, very intelligent guys saying, I'm going to trade that chart just as it is. I'm going to trade the 29-day cycle. Boy, have a look at it. Pretty extraordinary, isn't it? That's the power of time, and it's massive everywhere. So we're going to talk a bit about gold today because I know you all love gold, and we haven't talked about gold for quite a while. In fact, I wonder if my friend from Reading is with us today. Have a quick look through here. Just bear with me for a second. Because Anthony D, hi mate, he's a broker from Chicago. I haven't seen you for years. Good to have you with us. Gig just arrived. Gig is from North Carolina. He's a world champion golfer. Well, you spend enough time on the golf course, don't you, Gig? It's great. Richard's with us. Akshay's arrived. Peter's arrived. Leo is a new client from Canada. Good to have you with us, Leo. Steve's with us. We've said hello to most of these people. Lots of them, all Miles, of course, many Peters, Norbert, yeah. I'm looking for George Tarr's with us. Good, George, good to have you with us. Phil also. Mark's a new guy from the look of it. Good to have you with us. Of course, Vicky, we always welcome Vicky. How do I trade on a golf course? You're picking on me. Gig, I'll bet you know how, mate. I have the utmost faith in you to do all things at any time. And if you're picking the Danielcode trades, mate, it'll just make your round so much better. Excuse me. All right, let's move on. So the vibration for gold is 44. And if you go to the Danielcode website and click on the articles tab, which is right down near the top, you'll see that article. It's called Masterclass 2 Timing Gold. And I put the link there if you want to copy and paste that. And it is the basis of why I say 44 is the cycle for gold. I'm an attorney. I haven't practiced the law for 20 odd years, but once you're a lawyer, always a lawyer. You know, all of my training was based on the fact that you don't accept anything unless you can prove it. And that's a really good skeptical attitude to take towards your trading. There is so much BS spoken about in trading that, I mean, boy, it is a plethora of disinformation, isn't it? Is it plethora? Plethora, I think, of disinformation. But not here. Here you get the good stuff. This article shows the proof that 44 is the cycle for gold, the vibration, the main vibration. Have a look at this. This is a gold chart, and this is a 24 days to each bar. Each bar is made up of 24 trading days. Why are we using that? Well, we use 6-day charts, 12-day charts, and 24-day charts. 12 and 24 are all multiples of 6, of course, for our long-term analysis. And you should always start with the macro because you can see the major turning points, the major excitement and the drama that lives inside these markets. So just have a look at this. This is a 24-day chart. And you can see there's 1, 2, 3 spots of real emotion and 3 highs also, which were key turning points. So once we've got those, and we start with those, because we don't force the market into anything. You can't. The market does what the market does. What we do is we try to find what's the market telling us. So this is a 24-day chart, and we've started our 44 cycle count from the high that I had marked on that previous chart that you saw. And from that, you can see the first number is 22. Why is that there? Because it's time, times, and half. So 22 is and half. 44 is the whole number. And then it goes on with quarters. It's half of 22 is 11, and half of 44 is 22. Look what you get at the 55 cycle. There's your high. That's the 2011 high, which was hugely, hugely important at the time. Look at the cycle that came straight after it on the 66, which is 2.5 times. It's twice. It's shown as twice. It's actually 2.5. It gives you the next high, the rally high. Push on out to the 3.5 times. That's a very, very important low. How important? That low forecasts the next and the ultimate high, the all-time high in gold. That's what makes it important, is that it's related through its Danielcode ratios to that very, very important consolidation back in, believe it or not, that's back in about April 2006. Long time ago, isn't it? And the markets, to them, that's nothing. The markets remember all of that stuff and they keep on tracking. So there's your first look at what happens when you convert your bars to multiples of 6. So 6, 12, 24-day charts. They're all valid because they're based on 6, which is minor time to the Danielcode. Those of you who've done tutorials have actually had the pleasure of calculating it. So from the 24-day chart, we move down to the 12-day chart. Have a look at this, same thing. 44 and a half, 3.5 times from that important low. That's actually the closing high, July 2020. That's the closing high of the all-time high in gold. Exactly. Not maybe, not thereabouts, exactly. It's been in that chart forever. Let's have a look at the 6-day chart. This is our proposition that these things are all based on multiples of 6, because 6 is the vibration of all markets. The other vibration of 44 is an overlay. But you'll see all of our charts for forecasting purposes are 6, 12, and 24, or multiples of 6. What happens here? Look at this. We start that from a very important inside bar, I think it is. Remember, inside bars and outside bars are signposts to future price patterns. 44 from there straight in gives you the all-time high. It's actually the bar that gives you the closing high. The next bar is the chart high, but that's the closing high, August 2020. The next part of the cycle, 1.5 times after that, gives you the first rally back high. And as you go across looking at that, you get a very important low after the low. You get the first rally back, and you get the first pullback after the next major high, all on a 6-day chart. What does all that mean? Have a look at this. This is the 44 cycle and then half, all of it run through. Have a look what happened here. We get our all-time high in August 2020. We get a very important secondary high in March 2022. And look what this 44 cycle is showing up. These are the 44 cycle and half. So you've got 22, 33, 44, 55, 66, 77 as you go through. They're all 11, which is an half of an half, or a quarter if you like. Have a look what happened here. Why are we saying that? Because that's part of the Daniel's code on how markets progress. Time, times, and half. In here we've got time, we've got times, but we must remember to add and half. So the first correction from the all-time high, right on a Danielcode time ratio. The second correction, right on a Danielcode time ratio. I mean right on. These are 6-day bars. Okay? Remember, there's a 3-day variance that's not even on the chart, so it's pretty clever. There's the first major rally comes on the next cycle, 2.5. When it says 2.5, you know it's actually 3.5 because it doesn't count the first cycle. That's just how the way that tool works. Then at the next cycle, you get a minor high, important enough at the time. Skip the next cycle, go out to the 44 cycle from that important low that we identified. What have you got? You've got the March 2022 high. Exactly to the bar, not maybe, not close to, exactly. Now, having said that, remember all of these time cycles are valid for plus or minus 1 period, and that's simply a function of the number of bars that are not on the chart due to holidays and weekends, etc. Every important turn on gold has come on the 6th cycle. All of them. There it is. So, special New Year offer. Last time we had a webinar, I offered you a tutorial for any of you who haven't done a tutorial, or those of you who need a refresher, and I offered you a 20% discount. That offer is gone now, but I'm extending a new offer to the end of February. I've got space for 2. 1, 2, that's it. I do all these tutorials myself, and I can only do a maximum of 4 a month. That's absolutely fills the book. But I have 2 vacancies for the latter part of February. So if you would like to take advantage of that, you can save yourself $1,500 and have a full Danielcode tutorial on time and price and everything that is worthwhile knowing about markets. For $6,000, you can save yourself $1,500. So If you are interested in that, send me an email, jneedham@thedanielcode.com. For those of you who've taken the trouble of staying up to be on this webinar live, send it now. That way you can be sure that you'll be one of the first two, and I'll look forward to that. If you haven't already done a Danielcode tutorial, you're missing out on the greatest chance of your life. Let's move on. This is S&P. I've shown you how beautifully time cycles work on gold. And it is time cycles working on gold. That's what's controlling everything in these markets. And it's there and it's happening all the time. Have a look at this chart. This is the index. This is the S&P index. Time cycles are valid on both futures charts and the index. And you would think, roughly, you would think that the index was more accurate. Surprisingly enough, it's not. Futures charts are just as accurate as the index, but both are valid. So this takes you back to the 2007-2009 crash, which was great fun at the time, particularly if you were following the Danielcode and you were short. And boy, I remember the drama there. I was staying sometime after this, many years after this actually. I was staying with Mo, who's one of our very, very long-term traders, and he's a divisional manager at Wells Fargo, and he was running their Louisiana office for them, and of course running a hedge fund was long only. And honestly, the stories he was telling us of these poor people who were, you know, long only and couldn't get out and didn't get out. And, oh my goodness, it was mayhem. It was also a lot of tragedy involved. I mean, if you're going to be a trader, make sure you know what you're doing. It's the most wonderful and pleasurable thing in the world to know what you're doing and to be with the market the right way. If you don't understand, don't trade. Don't trade real money, you'll get killed. And for us, we understand time, so it's all clear, it's all set out, it's there in front of you all the time. So this was an old chart from the S&P index back from the high in 2007 into the crash low in 2009. And what we noticed is that going into the closing high, remember we have swing highs and closing highs. Closing high in this case was a 1 bar before the swing high. I noticed that it went 59 cycle on the 6-day chart, high to high, high to swing high on the index. Remember that because it's subtle. Look what happened after that. We see a time cycle. The most common things that time cycles do is they repeat. So we look for that to repeat. And here it is. The rundown from October 2007 into the crash low March 2009 was 59 days, 59 cycles of 6 days each, and that gave you the closing low, not the chart low. Remember, the first cycle went chart high to closing high. The repeat went chart high to closing low. I mean, that is awfully, awfully clever. You couldn't organize that yourself, but markets do. They know, and they do that sort of thing all the time, and it's extraordinary. So once we saw that, we'd seen that 59 cycle so dominant, we then had a look at what else that market had to tell us. And you can see that high to high from the .com high, I'm going back in time a bit for you now, through to the 2007 high was 80 cycles, 80 lots of 24 days. The same calculation from the low, the August 2002 low, after the 9/11 and everything else horrible in there, low to low was 70. Now 70 is a Danielcode cycle. We call it the heathen cycle. There's nothing heathen about it. It just comes from a different part of the book of Daniel. But since we started, you can see this Danielcode time tool here, which a lot of you have available to you if you've done a tutorial. 70 has always been a notable Danielcode cycle. It's particularly obvious in the DAX and in euro, any euro pairs in Forex. Very important, particularly if you're a DAX trader, because if you look what happened today, I think you've got a fair idea what's going to happen tomorrow. Okay, we'll deal with that in a moment. So what we've done now, because we saw how dominant the 59 cycle was, now remember, we're on a 24-day chart, 6 slots, 6 times 4, 24. We could spread this right out. We couldn't get it all on the chart, but for longer time cycles, this stuff is just deadly accurate, amazingly accurate. Shoot this for yourself. From the 2007 high, 59 on a 24-day chart twice takes you 118. That gave you the swing high of October 2018, which was the start of the first COVID correction. That was the first bit of drama about COVID. Then the market then recovered from that and roared up. Look at the next line underneath that. 70, from the 70 cycle we had, that got us to the close in March 2009. It was 70 low to low, from the after the dot-com low to that low. It was also at a 59 cycle, high to low. Closing high to swing low was 59. So we put the 59 cycle on here from the low. And nothing much happened at the 59, but twice the 59 to 118, that gave us that high, and that was the COVID flash crash. All of a sudden, COVID meant something, and there was drama aplenty, and that was a really fantastic move down, the shortest bear market in history of 24 days, and we were short all the way from day one. But they're very, very important vibrations. Have a look at those. October 2018 and March 2020. They are very big movements on a chart that didn't have a whole lot of drama in it up to that stage. And those are telling us that those two, they're both COVID reactions. They appear to us to be. We see things in terms of the news cycles. That's a COVID reaction. Well, October 2018 was a COVID reaction. And then the market decided to ignore it for a while. March 2020 was the flash crash, the COVID reaction. Well, that's just fitting news to what the market's done. Look at the time cycle. That's why those markets topped out and turned. Okay, now remember, time cycles are completely mute on quantum. They don't tell us we're just going to get a minor turn or whether we're going to have a big move. But undoubtedly, both these highs and lows around those two formations are very, very important, and you'll see why. We put the 59 on everything. What have we not done? Well, we had a 70 cycle sitting in there. And if we're interested in 70, we must also be interested in an half. If 70 is a measure of time, and it's one of the Danielcode cycles, and we're interested in 70, as we have been, then we must be interested in an half. And an half is 35. And 35 cycles on the 24-day chart took you exactly to the all-time high in the S&P. And if you look down at the bottom a little bit more, you'll see the DC 44 cycle from that important, vibration in October 2018, which came at the 118 from the high back in 2007. 44 days, 44 cycles, I call them 44-day cycles. They're 44 times 24-day cycles. Look what it gave you, the low in this whole pullback in the S&P to date. Marvelous, isn't it? Perfect. Well, there you are. That's time cycles for you. Have a look at this. This is the 12-day chart in the S&P. It's exactly the same as I've just shown you, but I've reduced this. Is now 2 lots of 6. This is a 12-day chart. Each one of these bars is 12 days. Look what happens at the 3.5 from the 2007 high. That's the low of this whole pullback beginning in January 2022. That's the low right there, right on its time cycle. And this is a different time cycle. It appears different because we've reduced this to a 12-day chart, but you were seeing it on a 24 and a 6-day chart, and it's been absolutely perfect. Just another way of looking at it. And if we look at those two structures, October 2018, March 2020, which I was so fascinated to see both those corrections, which were really the only substantial corrections you can see on that S&P chart. Remember, inside bars and outside bars are signposts to future price patterns and future cycles. And just 2 bars, here we are, with the blue lines of the start of the count. There are 2 lots of Danielcode time cycles on here, which is why you get 2 lots of 44, 2 lots of 59, 2 lots of 62. Well, the first 59 gave you the high in January 2022 on the 12-day chart. There it is. The next one, October 12th, 2022, gave you the low of the whole pullback here, and that was the closing low. The next number, which is 3.5 times, you can see it gave you the swing low. So this market's defining not only swing highs and swing lows, but closing highs and closing lows as well, which is pretty clever. And you'll have noticed the 59 for the first rally back after the high, right to the dot. We also got all of the others here on different charts. Okay, here we are. This is another example of outside bars are time signals. They are signposts to future time and price signals. You've seen this. This is a 6-day chart, the S&P futures contract. This is the back adjusted chart, 067. No, this is 057. That's the better one. I was going to say don't use that back adjusted chart. I know Trade Navigator love it for some reason and recommend people use it, but it gives you false prices. This is the 057 chart, which simply has the front month slap where it should be each time there's a rollover. And here's your 2 little outside bar signposts. You can see one gave you the 70 cycle. Why 70? Well, that's that cycle that showed us it was valid way back into the 2009 low. There's your 70 cycle. What did it give you? Gave you the high. January the 4th, a perihelion, for those of you who are into astronomy. And the next one, or I should say another outside bar, gave you 44 cycle into that exact same point. From there, the low before the high, very important market, high before highs and lows before highs, their timing markers, it gave you 44 into the low perfectly. There it was. Okay, so this market is running on its Danielcode numbers and ratios all the time. What I've got here is I just want to finish up, if I may, by showing you the importance and the accuracy of these Danielcode price levels, all of which come from members' charts. Now, excuse me, I haven't updated these charts. These charts come from Saturday or Sunday they were made, and these lots, some of these, yes, most of these were updated Wednesday night, and that's why the numbers are not quite in the right position because the market's moved on. But have a look at this. This is the British pound US dollar, and we're talking about target recognition. The high of this bar came in at 12194, which wasn't target recognition. It's too far away from our numbers. We only allow 0.1% variance of price from target. But look what it does at the close. Target recognition is valid at the bar, high, low, or the close. It goes up there, it sticks its head through, it knows it's gone too far, it says, oops, sorry, it runs back. Where does it close? 1.2122. There's your Danielcode number right there, sitting right next to it. Okay, there's that close, 1.2122. And there's your Danielcode number at the close, 1.2127, if you can see that. It's a little bit obscured part of it at the beginning. 1 tick variance. What's the next one? New Zealand US dollar. All of these trades, we've been in them. Some of them been pretty nice. Well, all trades are nice. They're winning trades are all wonderful. Have a look at this New Zealand US dollar. We've been on the long side of this since the low. Look at today's bar. Look at the high, 6390.6390. Call it 6390. Where's the Danielcode number there? 6390. Have a look at members' charts on the Danielcode website. You can see that that's been there since the low, at least. Yeah, perfect. This is an interesting one. This is a really tough market. It's having a hard battle in there. But I wanted to show you how precise it is. Here's our USD CAD, the loonie, if you like, a US dollar Canadian dollar pair, the loonie. The high of today's bar was 1.3463. What's the blue line number there, which has been on the charts for since the low? 1.3463. Zero variance. Okay, get used to it. This happens all the time. This is the proof that all of these ratios, which are based on 6, are everything. Here was a really nice trade we had in gold today. We had a sell in gold today. Look at the low of this bar. Low is at 1870.2, and look at the Danielcode number there, 1869.9. I don't know how much more accurate you can get. That's a variance of 3 ticks, which is 3 cents. They're just amazing stuff, isn't it? How accurate this stuff is. That's target recognition with a big T. I think that's probably an interesting one here. Germany's DAX completely played against the US market today. Have a look at this chart. Germany's DAX. It's interesting. I know not many of you trade it. We have some European clients who trade it. Some of them are very big traders, but it's very interesting. It sometimes leads the S&P and the Dow and NASDAQ, Russell, etc. And it has been recently. Look what happened today. The high here was 15,705. Where's the Danielcode number? 15,698. That's 7 ticks variance. Look what it does on the close. It pulls back and it closes at 15,568. Where's your Danielcode number? 15,565. How much more accurate can you get? And we've got a sell on that for tonight. Friday, of course, is the most bullish day of the week for equities, but we have a sell anyway. This is the Russell. We've been short Russell since the high, and I just want to share with you what this has done today. You can see the low of this bar today is 1915.3. Where's the Danielcode number there? 1917. Is that close enough? Not really. Not for me. What about the close? Remember, it's a bar, high, low, or the close. The close, 1924.2. Where's the Danielcode number? 1924.6. 4 ticks variance. Just about perfect target recognition. It's a very important part of the market process and one you should be aware of. This is sugar today. We've been short sugar and we've been long for quite a while into the high. We had a little correction and it's on its way up again. This is very, very nice. Look where the high came, 1533.6. Where was our number there? Sugar, help if I'm on the right chart. I'm looking at soybeans. Need to go a little bit further down than that. Here's sugar. There was that high, 21.73 was the chart high. That was the Danielcode black line, 21.73. Look how the market ran away from that number. A close above 21.73 would move the odds substantially in favour of the old swing being taken out. That doesn't mean a lot when they're so close as they are with these daily charts, but some of you will remember we had that same situation with gold when it was making its all-time high. And during a webinar, I said if you get a daily close above that black line, it means the swing is going to get taken out. Finished up being an enormous trade. It was wonderful. Interesting. See how this has run away from it? 21.71, and the actual high was 21.73. 2-tick variance. And that's that precision that you're getting. It's there all the time. This is silver. Very important trade here today. We were short today's silver into the low, and the low, it's been a pretty volatile market for a while. Have a look what happened today. It runs down and it's low and it gives us nothing. It then pulls back and it closes at 2214.5. Where's our number? 2213. Half a tick variance. Just perfectly perfect, isn't it? How does it do that? It does that all the time, and that's the way that it talks to you. It's saying to you, I know these numbers, I know these ratios, and I'm tracking them. So there were some nice trades for today. So if you missed our talk earlier, here we are. Special offer if you're really quick, if you're ready to start your tutorial in the month of February. I'm happy to give you a 20% discount, and let me know. Email jneedham@thedanielcode.com, jneedham@thedanielcode.com. So our life is happiness and goodwill and success. There's no inflation in trading futures and forex. All markets pay exactly the same going down as going up, which is wonderful. Interest rates only affect us as T-bond traders. Trading in T-bonds has been fabulous. Those of you who are trading T-bonds, remember what I showed you probably a couple of months ago, that you put the T-bonds chart in a top pane and put the S&P in the bottom pane. Remember, the T-bond chart is the government's view of what it's trying to do. The S&P is the market's view, traders' view of what it wants to do or thinks should be done. Don't bet against T-bonds. Eventually, they more often than not, they're right. So, drama and fiscal catastrophes just add volatility, which we love. It's a gift to us. Happy days. Learn to trade and learn to trade the Danielcode. Remember, the business of trading is making money. If you haven't already, you're most welcome. Go to the Danielcode website, www.thedanielcode.com, and have a free trial. If you've already had a free trial, the computer will likely remember your username and won't want to give you another one. It's mean. That computer, looking after its owner's interest. You have to, if that does happen, you contact Terry, support@thedanielcode.com, and he will assist you with that. Okay, Jeff, thank you for being with us, my friend. Good to see you here. And remember, folks, this is a disclaimer which I go to some trouble to show you at the end of every session. Trading, futures, and forex, and all derivatives, if you don't know what you're doing, it's risky, and it's really easy to lose your money. So don't risk real money until you are confident that you know how to trade. And the best way to learn how to trade is do a Danielcode tutorial, and I will teach you everything that's worth knowing. Okay, and that's about us for today. I think, let me see, I have a few little comments here to answer. Akshay, 30-year T-bond, time, cycles, and price. Jeff enjoyed it. That's grand. Akshay, send me an email. You asked the same question last time, and I asked you to send me an email. And if you just send me an email, jneedham@thedanielcode.com, I'll be happy to respond to you, my friend. I'm glad to see you with us as well. So that's it for today, folks. Gig is on the golf course, probably finished by now, heading for the 19th hole, I guess. Or might have been at the 19th hole and still there, whoever knows. But that's us for today, folks. Thank you for being with us. I hope you've understood that trading is governed by the Danielcode and the 6-day cycles are paramount. Bye-bye for now.